From an AvalonBay perspective, we feel like our portfolio is well positioned. As investors know, the bulk of our portfolio is in the suburban coastal markets, which over time just face significantly less new supply. Land's hard to come by, land that can be entitled for multifamily is hard to come by, and just the amount of time that it takes to get those entitlements.
I'm here today with Ben Schall, President and CEO of AvalonBay Communities. Ben, welcome.
Thank you. Thanks for having me.
So Ben, what are you seeing in terms of the multifamily supply outlook, and how is that impacting resident turnover, rent levels, and new development going forward?
Supply is a great place to start. We, as an apartment industry, are coming off of historic levels of new supply that have been making their way through the system. And while supply is coming down, it is still very much a determinant as we think about operating performance across markets and across submarkets. From an AvalonBay perspective, we feel like our portfolio is well positioned. As investors know, the bulk of our portfolio is in the suburban coastal markets, which over time just face significantly less new supply. Land's hard to come by, land that can be entitled for multifamily is hard to come by, and just the amount of time that it takes to get those entitlements. And so when you translate that through to today's environment, in 2025, we're projecting that we're only up against 1.2% of new stock, and that number is going lower as we head into 2026. For next year, our estimates is that in our established regions on the coasts, that the new supply in those markets is going to be down to 80 basis points. Really small levels, and at levels that we haven't seen in our markets in over 20 years. And given my comments about how challenging it is to get entitlements and how long it takes, our view is that those levels of supply likely remain lower for longer for a prolonged period of time. All of that is a lead up to say that the operating environment for us, supported by low levels of supply, steady demand in our core markets, sets up well. And you've seen that in our recent operating results. We had a very strong Q1, exceeded expectations there, partially driven by revenue. And then in advance of the conference, we issued an operating update. Again, continued operating momentum coming through our core portfolio.
And is there an aspect of your latest earnings report that you feel underscores your goals or priorities at this point?
I mean, first and foremost for us is driving superior earnings growth for shareholders. And for us, the metric we look at is core FFO. We are projecting this year at AvalonBay to deliver 3.5% core FFO growth, which is the highest in the sector. It's actually 300 basis points higher than the peer average. And so how are we able to do that? And there's really three areas that I would emphasize to you. First is portfolio positioning, which I talked about. Second is we've been very active in what we refer to as our operating model transformation, really rethinking how we deliver services to our residents, digitizing huge aspects of that delivery model, and particularly leveraging technology and centralized services. So we're about midway through that process. We've identified $80 million of annual incremental NOI that we think we can drive via our operating model initiatives. And so the way I like to describe that is we're sort of halfway through making good progress, but also a nice runway ahead as we think about delivering incremental earnings for shareholders. So portfolio positioning, the operating model transformation, and the third is particularly unique to AvalonBay, which is the incremental growth that we drive via development. We're by far the most active and scaled developer amongst the public REITs. And I'll break it down kind of two cohorts right now. First is we have roughly $3 billion under construction today. Those projects have been pre-funded, what we refer to as match funded, so capital we've already raised. And they're at the point in their construction projects where we've already bought out the bulk of those costs. So pre-funded, cost secured. And what those $3 billion of projects will deliver as they come online later this year, into 2026 and into 2027, is a boost in terms of both earnings and value creation to come for shareholders. And if anything, 2025 is actually a trough year for AvalonBay, just given the smaller level of start activity from a couple of years ago. So investors should think about sort of this being a trough in this element and then seeing significant growth as we get into 26 and into 2027. That's cohort one on the development side. The next cohort is how we think about our next set of development starts. And we're uniquely positioned there in that we raised $890 million of equity capital last year on a forward basis to fund go-forward development projects. So we raised that capital at $226 a share, has an initial cost of roughly 5%. And so what we're in the process now of is matching that capital against our next set of development starts. And we're targeting $1.6 billion of development starts in 2025. We're targeting returns in the low to mid sixes. And so the way that we think about that is we're generating 100 to 150 basis points of spread between our cost of capital and where we're targeting development yields. That, as you then get out into 2027, 2028, that's then the next wave of incremental earnings and value for shareholders. So that third piece is a key piece in terms of how over time we consistently deliver incremental value. And when you put the three together, portfolio positioning, operating model transformation, and our growth via development, that's how we deliver sector-leading earnings growth.
And can you point to an interesting transaction or development that will be impactful to the company this year or beyond?
Sure. We had a recent recent acquisition that we announced in our Texas markets. It was 8 assets, $620 million of buying. And we structured it with a smaller peer called BSR REIT. Dan Oberste is the CEO, so structured it with him and his team. Directly on strategy for us, we have portfolio allocation targets that we're pursuing. Part of that is we want to increase our suburban exposure. We're about 73% suburban today, looking to get to 80%. And then we've also want to grow what we call our expansion markets, which for us are a select set of Sunbelt markets. And we want to grow our exposure there to 25% over time. And this transaction allowed us to go from about 10% towards that target to 12%. So we're now also about halfway towards our expansion level target. It's directly aligned with the type of product we've been looking to buy in our expansion markets, which is lower density, lower price point product in the suburbs, consciously assets that we think will face less competition from new supply over time. Really like the basis and the price point that we're getting in now. One of the leading sort of KPIs that we've been putting out is we acquired these assets at $229,000 per door, so below replacement cost. And then the last element that gets us excited is these are the type of opportunities where we can both leverage our balance sheet strength, our access to liquidity, along with our strategic capabilities. And in a portfolio like this, along with most of the assets that we're buying, we're now tapping into our operating model prowess, what I referred to before, and bringing that to new growth, bringing that to new assets. So on this portfolio, we're underwriting that we can grow the yield on this portfolio by an incremental 30 to 40 basis points, get it up into the low fives by having these assets on our platform. And as I look ahead, those are the types of opportunities that we're seeking out. Places where we can tap our terrific balance sheet position, we're low leverage, we have a tremendous amount of liquidity, along with our strategic capabilities where we can generate outsized growth for shareholders by having those assets on our platform.